This is a Stock Trading Reality Podcast, episode 137.
I didn't even have a clue of what I didn't know, if that makes sense.
This is the Stock Trading Reality Podcast, where you get to see the realistic side of a trader's journey. Get inspired and stay motivated by everyday normal people who are currently on their journey to trading success. He is amazed by the apparent passion in the computer building crowd. Clay Trader.
It's actually a little scary. I mean, I know that the gun community can be pretty hardcore in terms of, oh no, that gun's better than that gun. Stock trading can be pretty, no, you got to do this versus that, you're an idiot. I mean, I get it, there's a lot of enthusiasts out there, but holy smokes, when IT Nate, the producer of the podcast here, when he ever does, videos about technology and computers and stuff like that, I just read through some of those YouTube comments and I'm thinking, will you just relax? I mean, calm down. It's not, I don't think it's the end of the world because maybe you don't agree with this, that, or the other that, Nate put in to build my computer or just his opinion on technology in general. So I have honestly been shocked at just how hardcore and how passionate the kind of technology, computer, I don't know how exactly you describe it, but the hardware, software people, they're pretty intense. And I know, Chezz, you have a background, where you used to work and stuff with computers and all that sort of stuff. So I'm sure you were well aware, but there's some pretty strong opinions out there when it comes to technology, isn't there?
I think that's the case for just about everything, like you said, kind of the gun community, but yeah, especially technology. You have AMD, superiority, and then Intel superiority, but yeah, I think just about any kind of thing where you have a choice between, maybe one or two large brands, there's always going to be people who are diehard for one and diehard for another.
Yeah, that is true. It's the Kool-Aid exists outside of just the stock market, I suppose. So, and that's what it is. I guess that's it. They just get behind that, technology, or they get behind the brand, and it's kind of do or die. So that does make sense. So valid point. And have you ever gotten in any massive disputes on the internet, on Twitter or somebody, just any social media drama fest based on this, AMD versus NVIDIA or whatever?
So sort of. So sometimes.
Oh, this should be good.
Well, I used to here in my younger days, where you pretty much. I feel like a lot of people do it to feel better about their purchase. So I actually purchased an AMD processor a long time ago, and I said, "Oh, you Intel people are dummies because you're spending twice as much, and I got the same power." And then after using the AMD processor, I went back to Intel, and now I'm a diehard Intel guy, and I'll never go back to AMD. So I kind of had to see. You shouldn't knock it until you try it. But then again, just like you said, it's pretty much once you drink the Kool-Aid. I really do think people feel better if they justify it by pretty much stomping on the other side.
No, I think that's exactly it. And that's I will buy that premise full bore. So, but we'll move on to our guest. But before we get to our guest, I've been meaning to do this more often than I have, and then I had somebody shoot us an email saying, "I really enjoy your podcast, even though it's like one massive sales pitch." And I'm like, all right, that's not really intent, but quick historical reference. If you're a longtime viewer, or listener, then you know this, but this was never intended for the general public. At first, in my mind, it was just going to be for our private trading group community, within, that what we call, the inner circle. That's what this whole thing was intended for. Let's talk to other members. Let's hear about, what courses they're going through, what, just all that sort of stuff. So yeah, that does include a lot of stuff that those people have purchased. So I do understand the person's point about, wow, you guys just do a bunch of sales pitch stuff. Good content, but you're right. Well, it was never intended for the public. But then, when the ball started rolling, ideas started to get knocked around. It was, long story short, why not open this up to the public? If somebody can benefit from it, even if they are not part of the, the community per se, then that's great too. That still helps people out. So that is why, the podcast is the way it is it was never for the public originally. It was intended just to, motivate and help one another within the community, but it ended up being public. So,
and I want to bring this up as well. We don't actually cherry pick the guests. There's never been a podcast that we've recorded with any. We broadcast these and release these for every single member who's ever volunteered to kind of talk about their story. So by no means are we cherry picking. It might sound like Clay only picks engineers to interview, but I promise they're just the ones who volunteer the most. So I mean, we're giving you whoever wants to talk about their story. So they just happen to be a part of our community. So I mean, that's that's just the way it is. But by no means, like Clay said, we never intended to do this as like, well, guys, if you can't learn to trade anywhere else, you have to kind of come here. So just wanted people to realize that.
Yeah, exactly. And that's it's totally, and for those of you that have listened a long time, you know that to be true, because we've had, people that are just absolutely killing it. We've had people that aren't even trading with real money yet. They're still going through the process. So, I mean, we've had the entire gamut, and that is the goal, hence the Stock Trading Reality podcast. The reality just happens to be people within the community. So, moving on to our guest, we are talking with Karl today, and for you chat room members, he does go by the same name in the chat room, Karl. And yeah, it got started and it kept going, and we thought, hey, this is a great conversation. So it ultimately turned out to be a two-parter. So this will be part one of Karl's journey, and he's a business owner. He's very meticulous about things, and he's done a lot of research into the strategy that he's using. And at first, it sounds really bad. And we joked around about, in the community at first, we're like, you do what? Wait, what's part of your strategy? That is actually, but now after talking with him, it all makes sense, especially when you consider kind of where he's at from a financial perspective. I get it. It makes sense. But he's doing very well for himself. And we go down lots of rabbit holes, hence the two-parter. So without further ado, let's hop into part one and hear from Karl. Karl, welcome to the show.
Howdy.
How you doing?
Pretty good.
Now, I want to give you a shout-out real quick, because I noticed in the chat room before we all hopped on the call here that you figured it would be polite to close the position, or your trading position, because you were going to be hanging out with Chezz and I. So I want to commend you for your politeness, because we've had many guests. I'm not going to name any names, but they are just openly trading as we're doing a podcast. I may or may not be guilty of trading during a podcast. Chezz may or may not be guilty of trading during a podcast. So from me to you, I appreciate your politeness and just closing position so that, your full focus is on this. So thank you very much.
So yeah, I can guarantee you I don't have Think or Swim open right now.
Now, is that is that tongue in cheek, or is Think or Swim really closed?
No, it's really open.
Because I'm hacking Karl's computer up right now, Clay, and I can confirm that he may or may not be truthful in this thing.
Now, and this, I want to bring up a question to you, Chezz. I guess you don't have to confirm nor deny anything, but have you ever traded during a podcast?
I've probably traded more than 10 podcasts. It really kind of depends if the market is moving or not. Sometimes when we have the podcast later in the afternoon, I mean, we've had podcasts through FOMC where I'm putting trades on after that and stuff. So, I mean, it just kind of depends on the market. Right now, I promise you, I actually am not. I have charts up all the time, but I'm not planning on putting on any trades because I want to hear Karl's story. I'm in tune with this. Clay, I don't think you have ever actually traded during a podcast, though. You've alerted stuff during podcasts, but I don't think you've ever traded.
I know I have before, a couple times, if one of those nuts alerts comes. So I guess the moral of the story that I'm going to cross here is Karl is a polite individual, and you and I are just jerks.
We're scumbags. Savages.
Yeah, we're scumbags. Savages. We're just savages. So that's... I have no defense to that accusation. So anyways,
I did just book
this. I'm also pretty excited
profit.
For this. Yeah, I'm pretty excited for this, Karl. I said, Karl, have you ever listened to any of these? Yeah, I listened to one, a couple episodes ago for like 20 minutes. So Karl is basically, he has no idea what he's getting into, and that's always not a bad thing. But this truly makes it about as genuine as possible. So Karl, I guess the first question I have for you, which we ask all our guests, is what is your Social Security number? Okay.
It's 662 327
555 5555.
Yeah. All right. Anyways, but in all seriousness, where did all this start for you, Karl? I mean, where did you first hear about the markets, and then what kind of got you interested enough to not only acknowledge the markets, but want to get a little bit more hands-on and take action within them?
So in the market in general, I had some investments from when I was born that did well, and that led to some other things. But basically that was always hands off. It was actively managed stuff that I didn't have anything to do with. And then, I always thought, okay, I owned a couple companies, and I like having, hands-on risk control. I didn't like the idea of, my money's just out there and I can't control, how hard are the workers working, how, are people showing up, things like that. So I didn't like the market. or I didn't like the idea of trading in the market or investing in the market. So I invested in myself and in the companies, and then went on vacation last year, my first vacation in my adult life, where it wasn't a working vacation. And, I was down there at the beach, and we're at the beach house, and, I see all these nice boats, and I'm thinking, okay, well, if I'm ever going to have this or that, or if I'm going to get to wherever I want to be in the future, I need to make more money. I need to take better control of my money, put it that way. And so that kind of led to me looking for, okay, I've got 2 companies. What's something else I could do that would, give me 3 avenues of income? And I had a couple of friends that did they still do some trading. Nothing terribly structured, more fundamental, I guess, if you had to put a title on it. But anyways, so that kind of got me looking at the market, and then I realized that one of my companies regularly held a large sum of money, and I was like, well, hey, if I could make just 1% on that would be great. If I could make 1%, low risk, just 1%, that'd be fantastic. Maybe 1% per month. And so that kind of led into July of last year, or June.
Okay, we'll pick up from July, but I had a quick question because you made an interesting statement, and it caught my eye. You had investments since you were born, so I'm assuming did your parents had set up an IRA for you right when you were born? But what exactly do you mean you had investments when you were born?
Money that was given, I guess you'd say, to me or to my estate at that point, that was just invested in the regular open market. It wasn't a IRA. I had a Roth IRA, I don't know, starting probably around 12, which is when I started working.
Okay, but I mean, when you were born, your parents had something set up for you then right away.
Well, I mean, it wasn't a IRA. It was just literally, it was just my mom worked for a place called Financial Concepts here in Columbus, Mississippi. And they did a real good job of managing the money. So there's a little plug for them. But basically, they gave Rhonda Ferguson the money, and it just went on its way until
nice. So
97.
Good on your parents then.
Yeah.
Basically, is the moral of this story. I mean, they were thinking about numbers in you from essentially the get-go.
Sure.
So now, did I also hear that right? At age 12, you set up an IRA?
If just going off of memory, yes. We started our...
Well, when you were young, when you're like not...
Well, no, I mean, we started our
young,
first company when I was
IRA.
12. To contribute to a Roth IRA, you have to have taxable income. So my assumption is that's when we started it.
Okay, no, that's... so I guess parents out there, and I'm talking to myself now when I say this, I guess it's never too soon to get things started, to get that ball rolling. And if you're a 12-year-old, 13-year-old, 14-year-old listening to this... What are you waiting for? Let's go. Get that IRA started, right,
I was just going to
Chezz?
say, I want to rephrase this. It has nothing to do with parents besides the fact that you need to put your children to work at 12 years old. So Karl's obviously done fine. He's still kicking here. But yes, it's pretty amazing that, just the fact that you had said, you needed to have taxable income to set that up. And at 12 years old, you had taxable income. So that's a pretty big rarity, I would say, nowadays. It is not very common for 12-year-olds to, at 12 years old, I was riding my bike off of ramps and getting hurt, and Karl's probably out doing... What were you doing at 12? Because now I'm really intrigued.
So in 98, which is when I was 12, we had a storm that came through and knocked down, we ended up with 1,000 stumps after this storm on our 16-acre property that my father had spent 17 years cleaning up, basically by hand. And, they had a nice place. And anyways, it got wrecked by the storm. So he got a price for the stump grinding, which was $8,000. And he was like, I work for a living. I can't afford to pay $8,000 and have nothing to show for it. So instead, I put up the money, and we bought our first stump grinder for $27,000 in 98.
At age 12, you put up $27,000?
Well, remember, it wasn't managed by me. So it wasn't any innate benefit, or it wasn't any innate talent of myself. But yes.
That's awesome. No,
he was involved. Yeah, that's pretty nuts.
Yeah, no, that's cool. So now I guess I knew that you were in the stump grinding business, but I never knew exactly the history of it. So, and I also like the point about, and I don't know if I'm as hardcore as you in this feeling, but I do understand, and I totally can relate to you, the stock market scaring you in regards to you only have so much control over it. I mean, whether or not people are showing up on time, the quality of work they're doing, this, that, and the other, which I think is also why I got into real estate first before, investing, into my retirement accounts, quote unquote, in the stock market. Because at least with real estate, it's like, yeah, if something goes bad, you just go look in the mirror and, point at that person, and there you go. It's that person's fault. But, and how exactly was it? Just those boats, those fans, that, the fanciness when you went to that beach house? Is that where what kind of overcame that thought process for you, or is there more to it? Because that's a pretty interesting transition that you would have to go to kind of wanting to keep everything in your hands versus, being willing to kind of put your money in a more hands-off type of way. So was it just the fancy boats, or is there more to it than that?
Well, no, I mean, the fancy boats were more of a symbol of, an easier life, so to speak, basically an easier life. And so I wasn't necessarily looking for stock trading. I was looking for a third source of income, so that way collectively all three could, perhaps get me further in life than any individual one would by itself. And so, I thought about that. That was in May. I think I opened my first trading account in probably late June, which only lasted there for maybe a week. It was a good old Robinhood. And then went to Interactive Brokers. So
okay, let's talk. No. Well, you can't skip over.
Well, no, I was going to finish answering your question, but I keep giving you these little Easter eggs for you to pick at.
That's right, and we're Clay's about to dig in right now. So go ahead, Clay.
I was going to say, so you were only with Robinhood for about a week. A lot of listeners out there, a lot of people. Robinhood, it's free, therefore it's the greatest thing ever. So for something that's free, why were you only there for a week? What was your experience with Robinhood?
So, I mean, long story short, personally, I don't have an innate disdain for Robinhood. I think that, it serves a market. Hopefully it's profitable for them. But for me, I'm generally skeptical towards things that are free. So, I already entered that idea with, okay, I'm already not liking getting stuff for free. And then two, I had a issue with, I think I had a Robinhood Instant account, but it wasn't, they had all these fancy names, like you have, I think Robinhood Instant, Robinhood, I think Gold now. But the main issue that I ran into was like it would say, tomorrow you're going to have X number of dollars of buying power. But then tomorrow rolled around and the number was a fraction, the actual number was a fraction of that number. And so it irritated me that my money was tied up. I started, I think, with $1,000 or $2,000 in Robinhood. I knew about the pattern day trading rule. But anyways, I decided, pretty quickly that, okay, hey, pattern day trading rule sucks. I can't, my buying power is T+3 at that point. I don't like it. So I went on to Interactive Brokers and opened up an account above pattern day trader, so I wouldn't have to worry about that anymore.
And obviously I've kind of, known you since you had joined the community, and I didn't kind of realize that you had gone through kind of that Robinhood experience. And obviously you have enough capital on the side that, you kind of recognize you didn't like the PDT rule, so you're just like, okay, well, I can easily overcome this. And I'm actually in the same boat as you. I used to be a big proponent of, if I can find it for free, then good on me, great. I saved myself a couple bucks. But the longer I've been on this earth, the more I realize you really do get what you pay for. So I mean, you kind of nailed it. Robinhood is kind of a no frills thing. It definitely has its market for kind of certain applications, but yeah, when they're kind of telling you things like you'll have a certain amount of buying power the next day and you kind of wake up and it's not there, that makes it kind of useless for you in terms of if you were kind of planning your day. So you would kind of recognize that you probably need to go to an actual brokerage. You're kind of already seen that, I'd like the ability to kind of sell the same day and not, have flags and all this other stuff. So you open up your account at IB. I guess what I really want to know is, at the time you had that Robinhood account, with the small account, what were you using as your criteria to kind of pick trades or pick stocks? This is always an interesting question, because some people just say, I found things that I know about, like the cars I drive or the appliances in my house. What was your criteria specifically?
So, I do a lot of reading about anything. I like to learn about whatever I can. And so, I'd probably been reading for a couple of weeks about just trading in general. And, everybody said you need to have a strategy. And I was like, okay, that's great. What is a strategy? What's the theory here? And, I knew that no one could really tell me a strategy, but it sure would make it easier if somebody was just like, hey, this is what I do and this is why. So I can, have a basis of understanding. And, fast forward to now, and I understand that, your strategy is what you do is for you and the way you think. But when I first started Robinhood, it was basically just things that I was familiar with, and shotgun trading, just throw out enough pellets and you'll hit something. And I mean, I left Robinhood positive, but
You're one of the few.
I mean, to me, Robinhood isn't a bad thing. It's very limited, but if that limitation is inside of your what you're trying to do, like for example, if they did IRAs and you had no commissions, okay, maybe. I mean, very very distant maybe, but if you had like a $5,000 Roth IRA, then commissions will be a bigger portion of your trade plan. Maybe not trade plan.
Yeah, no.
But,
yeah, I mean, it's definitely, I don't have anything against Robinhood, but there's just too many people that I've come across that, I want a day trade scalp. I'm like, okay, well, Robinhood, you can only have a phone app, yeah? It's free. I want a day trade scalp. It's like, do you know what day trading scalping requires? And sometimes you just got to day trade scalping from your using Robinhood on your phone. It's not going to turn out well for you. Whereas to Karl's point, which I fully agree, if they had IRA and you can, open up a long-term IRA account with Robinhood and not have any fees on it, IRA being just investing long-term, then yeah, the Robinhood, that's perfectly fine. But sometimes trading from your phone, depending on keyword strategy, is gonna dictate what sort of sense it actually makes. So how did you exactly find Interactive Brokers though, when you were, I don't like this pattern day trading stuff? Where did Interactive Brokers come from? Did you talk to somebody? Was it just from a Google search or what?
Actually, you just reminded me. I have a friend of a friend. I have a lot of friends from the online communities that I'm in, and a friend of a friend in Washington State did some trading and did day trading, and I was trying to, just learn about okay, which brokers do I want to use? So of course, I did the Google and was searching and came up with a few. Okay, here's a couple of recommendations. Like I think my first might have been an options house, I think, but then there was an issue with funding. I have a established wire account, and apparently the wire account has to have my name on it, which was fine, but they didn't tell me about it, so it irritated me. So I just closed that account and moved on. And then talking to this guy in Washington State, he said he used Interactive Brokers. He liked them, so I looked at them. I liked their minimum fee was $1 per share commission, which works well depending on your position size. Sometimes it works well, sometimes it works very poorly. They had very low margin rates, which probably shouldn't have been a big criteria starting out trading, but I didn't find a whole lot of things I didn't like about them. And at that point, I wasn't very chart dependent. Or I wasn't as chart dependent as I am now. I was, yeah, that's pretty accurate.
Okay. No, so a friend of a friend, and that's, sometimes that's always a fine line, because I got a stock pick from a friend. It's like, okay, well, that's where things can get a little sketchy. But yeah, I mean, that's cool, and that makes sense that somebody just recommended that, and you did your research, and you're still with them right now, if I remember.
No, I left beginning of this month because I kept screwing around with the margin requirements.
Okay, I guess we'll get to that later on down there, because I remember we were talking about that.
I was looking at Lightspeed
in the chat room a while ago. Yeah. Okay, we'll get to that, I'm sure. So, okay, so you signed up with Interactive Brokers, and you just said, disclosed with Robinhood it was more of a shotgun approach, and you left green. So I'm assuming at this point in time you're thinking, hey, shotgun approach works. Did you start doing that with Interactive Brokers, or did you enter this new broker with a totally different mindset?
It's still mainly the same. I mean, now looking back at it, it would be a shotgun approach. At that time, I really didn't have a frame of reference to say, okay, I didn't even have a clue of what I didn't know, if that makes sense. Well said. Yep. And I mean, granted, I do a lot of reading. We'll get to that later. So anyways, I kept doing basically the same thing at Interactive Brokers, but also now I could short. So there was that added benefit. So just from that was I started with Interactive Brokers. I call it July 15th of last year, and so then I was just doing the shotgun approach up until it works till it doesn't.
Right. So I obviously have like I said, I pretty much recognize you from the time you've joined until we're doing this podcast here. I guess obviously going from a shotgun approach to now I know you are a very, very meticulous person who only trades volatility products. How did you kind of go down that route? Was that another kind of you would in some of your research and stuff you kind of saw, hey, this is working for this guy, maybe I'll give this a try, or what led you there? Because obviously it's kind of interesting for me to hear, because I never knew you when you were doing the shotgun approach. I've only known you since you've literally only had like one focused strategy, and there's absolutely nothing wrong with that because it's treated you really well. But how did you even kind of come across strictly focusing on volatility products?
Well, so I found UVXY sometime between July and October of last year. It had been maybe August perhaps, and I was just scanning around, not really anything organized in terms of a scan. I think I was scanning for biggest gains or biggest losers of the day, maybe. Anyways, and I came across this chart, and I was using candlestick charts. Didn't know near about what I know about them now, but anyway, I was using candlestick charts, and the wicks. There was now I know it's called a channel, but basically there was like a 10-minute period where I came across this ticker symbol. I just happened to click on it, and here's 1 minute wicks that are, I can't remember what it was, maybe $1. I can't remember. I think the price then was like $13, $17, $20 a share. So maybe it was whatever it was. I noticed it was just literally going in a channel, and I was like, well, hey, this is easy. So to start off with, I'd buy how many ever shares at the bottom of the channel, and then as soon as it hit the top, I would sell twice as many shares. So then I'd be instantly short. And I did that back and forth, I don't know how many times, and it worked. So I kept trading UVXY, did some reading on UVXY, heard about the decay and all this other stuff. Never really found anyone else that was trading volatility heavily until probably this year. But anyways, so I found UVXY just scanning and found some candles that I liked because it was in a channel. And so I would go both long and short on UVXY at that point.
So you just turned it right into your ATM machine. Real quick for listeners out there, if you're new, volatility products, what does that even mean? I mean, it's a stock market. There's ways to pretty much trade anything you want. And the market, I'm sure maybe you've heard it, is volatile. And because the market is volatile, there are ways that you can trade that volatility as volatility itself. I mean, sure, you can enter a stock and play the market's volatility, but the market's volatility, quote unquote, there are also, ticker symbols that allow you to capitalize on that. So that's what volatility products, we are referring to, is a way to capture not a particular stock's volatility, but just a way to capture the market's volatility in general. So hopefully that makes sense. But yeah,
we're not trading implied volatility or historic volatility. We're trading cumulative volatility.
Right. So just the amazing thing about the market is if you want to trade some soybeans, you can go trade some soybeans. If you want to trade volatility itself, you can trade volatility itself. So just out of curiosity, you made the comment that your whole shotgun approach worked until it didn't work. So when it didn't work, was that like a massive blow up, or was it just a bunch of small little paper cuts that eventually were just kind of discouraged you and caused you to start to move on?
So I'm kind of have a history of just doing things kind of all out. And so it was more spectacular than not. So like in July, I think I started my account with Interactive Brokers with 70 grand. That was July 15th. Then in early October, I made it up to about 94,000. So $24,000 of gain on a $70,000 account. That's somewhere around 40%, 38% maybe. Anyways, and so it was working. And then, it was death by, I don't know, 5 cuts that ended up draining about $41,000 of profit, or $41,000 of capital out of the account.
Now, so obviously you didn't quit the market with that happening.
God, no, you got to be stubborn.
There you go. and Karl, now, knowing you as I do now, you wouldn't have it any other way. But so here's the thing. So you take these kind of string of losers. Is it just from a couple bad positions? And I'm assuming this is from volatility trading.
No, because I was still shotgunning at this point.
Remember? No, this was the end to a shotgun when he made the comment.
This is what ended the spectacular shotgun.
Yeah.
Gotcha.
When it didn't work any longer. Well, this is when it didn't work any longer. Yeah.
So this is back also when I would go long and short on UVXY. Or volatility in general, as opposed to now I only short. But the I remember there's a few things. So one, Netflix gapped up in October of last year, third quarter earnings. It gapped up like 20% overnight. So I ended up shorting it at, I can't remember, 123, give or take, I think. Somewhere in there. Anyways, my theory, my guess, my inclination was that it would pull back to at least 110, or around 110 was my theory on where it would at least pull back to. And, the price kept going away from me, and, I was on the lovely StockTwits, I think is what it's called. Looking, and everybody was talking about how analysts were saying it was going to go to 150, and I was thinking, well, geez, I'm short, I think 2,000 shares. This is going to get bad quick. So I ended up taking a loss. And then sure enough, like 2 weeks later, I think it hit a low of 110.68 maybe. So ironically, I think I took an $11,000 loss on UVXY. I think it was $8-something thousand on Netflix. So we still have that's half of the loss. There might have been more than one loss in UVXY. I don't really recall. But ironically, every position that I took a loss on ended up being a winner. I ended up being right, which, fast forward to now, and that's not always the case. But, back then I ended up being right. But I realized, that's not a very sustainable thing. I went from 94,000 to 53,000 in the span of 2 weeks. And, that's a pretty steep negative trend.
That's a big swing too.
Yeah, it was. It sure seemed like it.
Well, yeah, you're like
Karl,
you said.
Karl's definitely aggressive, but still.
Yeah, no. Like I said, Chezz, you summed it perfectly. Now knowing Karl, he wouldn't have it any other way. That's Karl. So I mean, I'm just sitting back, and this is good stuff. I'm eating my Sour Patch Kids over here. Karl, keep it up, man. Go for it, Chezz. I know you got something.
So you obviously take your account takes a big haircut, and it sounds like you've already realized that some things need to change. That type of account volatility for successful people, you kind of attributed to having boats and things like that. Just people who are living a more comfortable life. Generally, their account values should not fluctuate that much.
Yeah, they shouldn't have that much.
This is when you kind of right, exactly. So you kind of find a more focused strategy. Did you add more money to the account at this time? Because obviously you're still well above PDT and stuff like that. But you just kind of decided to use what capital you had left and redeploy into a different strategy, right?
So I wouldn't necessarily call it a new strategy. It was more that I finally realized the overall trend of UVXY. And, before I actually knew the phrase then, the trend is your friend. And so there was after I looked at it and, came up with the idea, I was like, okay, so October 24th, I decided, okay, so now all I'm going to do is short volatility. That's all I'm going to do. This is like
based on the trend, right?
Based on UVXY has lost 70 to 90% each year since its inception in 2011. That's
right. So the trend had been bearish, like you said. Maybe at the time you didn't know the trend was your friend.
Right. I definitely didn't know the phrase, but
that you were going to short.
I realized that UVXY is garbage, kind of. You don't hold it long term. So if it's garbage, it's a depreciating asset. Then if you can short it, then my God, short it. That's a pretty solid idea, I think. And so. That was October 24th. Ironically, for the next 9 trading days, UVXY set a record for the most days green in a row. And so I had a $54,000 account. I had shorted, I can't remember how many shares at this point, and that $54,000 account was $17,000 upside down. So, that was the first test of this strategy, so to speak. Was I just lost. Over the span of a couple of weeks, I just lost $41,000, and started this new strategy. And then now I'm upside down another third of my account, another $17,000. And then go ahead.
No, I'm just kind of sitting here with an evil grin on my face because I can totally relate to, hey, I have a new strategy, let's go. And then
that's how the market works.
And then the new strategy just punches you in your face, and you're just like, but yes, but that's why I'm smiling, because I know there is a but.
And
so this is good.
One of the big things that myself and several members of IC clashed about was my lack of stop loss. If you remember back to when I lost all the money, each one of those positions by this point would have been in the money, and instead of losing 50 something, how many ever $1,000, Netflix in and of itself would have made 18 grand, 18, 20, somewhere in there. So I mean, anyways, so an innate disdain for just taking a loss if there's such a prevalent trend such as UVXY. And so, I held it, and it went against me for 9 days, set a new record, go me. Kind of like you said before in undoubtedly your published information, that, when you buy a house, you don't make the profit when you buy the house. When you sell the house, you make the profit when you bought the house. So my entry on UVX...
You're going to bring a tear to my eye.
Yeah, I try. UVXY, my entry was absolute garbage. However, November 28th, I closed the position for a 9.5% gain on the account. So a month and 4 days, 9.5% on the account. I could live with that. I ended up getting back to break even, or back to my original 70,000 in early to mid December. And then sometime in December or January is when I started putting some more money with it after, I saw that this strategy potentially had some legs with the way that I think.
So, and I do remember that, and I remember trying to keep up, and then I chimed in. I was like, wait, there's no stop loss, and you're like, oh, everybody's just explaining that. So, but that's the thing about the market is there's many strategies out there, and if it works until it doesn't work. But so far, it continues to work for you, not just right. And there's no stop losses, right? Is that how this UVXY strategy essentially works from an overall context?
It depends on your definition of stop loss. So, like, for example, Hooch doesn't normally use stop losses on cheapies because he just assumes that it's okay for it to be a total loss. And at this point, I could lose my entire account balance and still owe tax on the year. So, getting to this point,
so that is how you're defining the risk is.
You can only lose so much until you actually owe the brokerage.
And correct me if I'm wrong, Karl. You've done, because I know you're big into kind of historical analysis of things. You've almost done the math too, as well as what is the largest spike UVXY or the VIX in particular has had over X amount of years. And based on your account value and position sizes, whether you can weather that storm. Is that
sure?
That's correct, isn't it?
And also now, I primarily go long on SVXY or XIV. I give the nod to SVXY for tax benefits. But back when all this started, I didn't start doing that till July somethingth. So anyways, shorting UVXY, Chezz is right. I have a spreadsheet where I could take my account balance, the entry price, and actually it would tell me the max number of shares that I could have. Like in the chat room, sometimes I'll say my max position size is this, and people think that implies that I'm putting all of my account into that position, when in fact it's actually just a fraction of the account, so that with UVXY at a minimum, the price would have to double before I'd have a margin call and have to sell any shares. So yes, my strategy involved using a portion of my account to actually secure the position, and then having a large amount of capital as a buffer to absorb, for example, 9-day swings against me.
I was very fascinated for this interview because I wanted to hear more about this, but it totally makes sense because the market is totally relative, and your example of Hooch not using a stop loss because he's risking, I don't know what, like $50 or whatever on these small positions. I don't know what it is, but
yeah, it's small.
Yeah, in his mind, it's all relative, right? In his mind, let's just use $50. $50, who cares? If I lose it all, whatever. So I'm not going to, put a stop loss in, so I only lose 25 instead of 50. It's $50. So maybe you're sitting there thinking, $50, holy crap. That's like a tank of gas. I would never just throw $50 out there with no stop loss. It's all relative. It's subjective, whatever term you want to use. However, for you, Karl, your amount is just a lot bigger than $50 in terms of what you're perfectly fine with losing. So if you could literally blow up your account, but like the comment you made, you would still have taxes to pay on the overall gains you've made for the year. Am I understanding that right?
Yes. And it's not so much that I want to lose the money, but before I have to take any loss, the price would have had to have more than doubled before I had to start losing shares and you start scaling out of the position, et cetera, et cetera. I had no desire to really lose all of the money by any means.
Well, yeah,
but my risk tolerance was higher.
If you're sitting here like, my goal is I'm trying to blow up my account, I would say, Karl, I'm going to put a straitjacket on you. I'm taking you to the hospital. But the point is, you are psychologically okay you're
only because of the
$50
trend.
is
only because of the trend.
Yeah.
This morning I did my second RVR trade, my CTU trade, whichever I call them both. So I did my second RVR trade, and the amount that I risked, because it wasn't a defined trend in terms of since its inception, it's only gone one way. I risked a whopping $35.
And how did that trade turn out for you?
Well, luckily I'm on free commissions right now with UVXY. So, I'm sorry, I'm on free commissions with Thinkorswim, and so I made a whopping $11.60, which is, I mean, it was
nice. But how did you feel good about the habits and all that stuff though? Good.
I don't know if I say I felt good about the habits or not habits yet. I felt like it was good practice for forming habits.
Well, there you go. So my main point here is this, though, that if Karl were to blow up his account, you're not living under a bridge. You're not knocking on Chezz's or my door with a little tin cup saying, can you give me a quarter? That's not going to ruin your life. Am I correct in saying that?
We're progressing more and more towards the trader life, but sure.
Okay, because what I'm trying to make a distinction here, and Chezz, feel free to chime in ever, but I don't want to listen to be like, hey, this Karl guy doesn't use stop losses.
Sure. So yeah, so in context of the time frame, back in October, trading, like for me back then on the shotgun approach, some days I would negate work with one of the other two companies and might stay home and make a whopping $40 after commissions because I was learning how to trade, or so I thought. And so anyways, when I started this particular strategy, $54,000 was definitely not going to make or break me. And as the strategy has progressed, I became more and more conservative, or more and more protective of my capital, or my oxygen, I guess, if you were a diver.
I like that analogy.
You're gonna bring tears to Clay's eyes again.
I'll try.
But my ultimate goal here is that if you were to lose that account, you are not leaving on the streets, right? Let's just take an absolute worst case scenario. I realize that the absolute worst case scenario is like really, really hard to occur. But if that were to happen, you're not leaving on the streets. Is that accurate?
That is accurate. However, now my current strategy is different than October because of some education.
Okay. But let's just for listeners.
Sure. No.
So just because you hear him saying no stop losses, that doesn't mean that you can go take your money that you need for rent and then go start doing all this, volatility product with no stop losses.
I also want to jump in here. The fact that people need to realize that while, yes, just like you said, regardless of stop loss or not, Karl knows, similar to options traders, Karl is literally playing the probabilities. He's looked back in the past and said, wow, this occurrence of the price doubling has only happened once in the past 12 years or something like that. That's a pretty good odds that, one time out of 12 years for, especially considering trading days, he's looking at it from a probabilistic standpoint. And just like Clay said, all his eggs are not in one basket. Karl is a man of multiple income streams. It's not that it's play money to him, it just won't break him. This is something he's looking at, speculative growth, and he's quite aggressive with it, and obviously he's got kind of the numbers to prove it. Karl, did you ever disclose what you took that account up to afterwards? Because I know I know the figures from the chat room, but I wasn't sure if you kind of mentioned that. If you don't want to, you don't have to either.
Like, I wasn't trying, or I understand Clay's trying to make sure listeners don't hear this podcast and are like, oh, Clay's an idiot, I'm going to put all my rent money in this and don't need a stop loss. So remember, we're also only to October, or now December, in the time frame. So we still have another, 10 months almost? For example, I bought CTU in February. What I was getting at when I said that I've became more conservative with the strategy was that I'm growing less and less desirable. I have less and less desire to watch my account go, $60,000 in the red to come back a month later and make 10 grand. So at this point in the conversation, we're only up to December of last year. At the peak, I had a big quagmire with Interactive Brokers in August of this year, and ended up closing a position for a loss, or two positions for a loss, to move the cash somewhere else so that I would have to spend 4 to 8 days doing what is it called, ACATs, where you move the position to a different brokerage. So before they started screwing around with the margin, I was up roughly $150,000 on the year.
Very nice.
That'd be year to date, January to August 8th.
And you don't. Correct me if I'm wrong, but the only losses you took were those ones where you just took them so you can move your accounts.
So no, that was 2 August 8th. So at that point, I'd never had this strategy had never had a losing position.
Okay, so because that's where I feel like Karl and I can relate, because yes, theoretically, if Karl were to take a losing one, if something crazy happens, yeah, it would be a good epic sized loser. Just like when I trade with my scalping, when I lose, yeah, they're definitely, I'm not going to call it epic losses, but they're definitely bigger than what my gains are for the most part. However, what I can totally relate to Karl in the sense of, risk versus reward can also be equaled out via winning percentages. If you have a super high winning percentage strategy, then sure, you may be, your risk monetarily may be more than what your rewards are maybe spitting out. But because you win so much more, it totally compensates in your favor.
Sure.
So
if you're winning 95% of the time, those I promise you, making 95 trades that are green versus the 5 losers you have, if those 5 losers wiped out 95 trades, then we'd have a problem. But obviously,
exactly.
You're proof that that's not the case. You'll never let something spiral that far out of control.
Actually, on that, I have some numbers. Because I looked at my numbers to haggle with TD Ameritrade on commissions and such. So from January 3rd till at this point it had been September, but in the month of August I made very few trades. I had made 1,650 trades roughly. Of those 1,650 trades, that trade was a loser. The position was still positive, but I took I think a $5,000 loss selling some shares just to increase my capital reserve, excess liquidity. There we go. My excess liquidity in case the spike continued on. Ended up, it wouldn't have reached it anyways, but I had one losing trade out of 1,650, which is a pretty good average. It's like 99 point
yeah, that
something.
number. Yeah, and that speaks for itself. And that's the whole point is, and I want to piggyback and really beat this dead horse one more time. It's not like Karl is freaking like, hey, where's my dart at?
Sure. Yeah, it's definitely not.
All right, that's the trade I'm making. No, he has researched this stuff to the hilt. He's got spreadsheets. He's a total geek when it comes to this stuff, and I say that
absolutely
as a total compliment. So it's not like there's
no
randomness. It's not. Yeah, there's no shotgun. And
it's a sniper rifle, not a shotgun anymore.
Yeah, the way the strategy functions is, there's a lot that has gone into it, and I guess I'll leave this up to you. But is there? Because I know what's gonna happen. I want to know Karl's strategy. How much money do I need for Karl's strategy? Oh, don't ask that first off. But I mean, correct me if I'm wrong. You need a good-sized capital account to be able to execute the way you are. Is that correct,
So
Karl?
Actually, one thing that I always focus on, not trying to, I understand you're trying to make this sound bad, and it is absolutely horrific.
I'm not trying to make it sound bad. I'm just trying to set expectations.
You're trying to make it sound bad so people don't jump in and
if somebody gets a hold of us and says, hey, I have $500 and I want this 99% win rate strategy that Karl does, can I do it with $500? I'm assuming the answer is no.
No, you'd have to be at the very least above pattern day trader plus whatever your unrealized loss is.
Okay, so we'll just take minimum. You're looking at at least. Now this is actually the number's higher, but just for argument's sake, $25,000 to even be thinking at all about trying
plus unrealized loss.
Plus unrealized loss, but just
so
$25,000. Okay, $40,000. So if you are not at $40,000, then don't worry about it. You got either you can pick up more jobs, you can start some businesses like Karl's done to build. I don't know how you build your account. That's up to you. But please don't be contacting Chezz and I or wanting Karl's email because you want to pick his brain because you have a $2,000 account. Now if you have $2,000, good on you. That's good job. If you saved up, that's awesome. I'm not poo-pooing on that. But point here being, not only does it take a lot of homework, which Karl has done, it also just takes capital. So
and another good point is that if you have a small account, most likely you're not trading for a living, and you don't want your trading to affect your day job. one of my.
And this one is you're saying it's pretty high or time intensive in terms of when it's going on. You want to be paying attention, right?
No. I'm saying when your account is 40% against you in the red. For example, one of my friends I grew up with is a dentist. He used to trade. I've suggested he doesn't trade now, but I've suggested that probably don't do this, because if you're working on someone, he's a dentist, if you're whatever your job is, and you're too distracted because, oh my God, my account's $16,000 upside down on a $40,000 account, that's going to affect the average person's day-to-day interactions with people, which could end up you losing your guaranteed trade being your job, and then you're in a big world of ouch.
Right. And for you, your distinction comes in the sense of what? Because
discipline.
You own your own businesses, is that, and you have plenty of rainy day funds, is that how you overcome that mental hurdle?
Just no stranger to the pain.
So you've kind of built up your pain tolerance.
Yeah,
there.
it's cumulative risk management over all of my stuff. And then also, I understand. I also have 1,800 trades now, shorting volatility. So I know that, when I took this $31,000 loss to leave Interactive Brokers, that, I'm literally given an account size. I could be literally one volatility spike away from being back green from where I left. And when I left, I left profits there. It wasn't all just my money, so to speak. It's all profit, so it's all my money. But, my break back even point at this point is like a whopping 17,000. Comparatively, it's not insurmountable. Anyway, basically, long story short, like you were saying, have a lot of research, have a lot of time in this particular strategy, and so that helps me get through the day when you're, $60,000 upside down on something.
And in the back of your mind, and there's no doubt in my mind, you also know that you're not going to be living under a bridge. You're still going to be able to pay the rent if that were to go, which is, like you're saying, because that's an excellent point, especially with your dentist buddy. There is no way I want it. So if my dentist is listening to this, please, if you're putting yourself in a situation where it's, you can't handle that and you're drilling the wrong tooth because I got a cavity, but hey, doc, I thought that was my other side of my mouth. Oh yeah, sorry, I'm in this Karl trade that went. Oh my!
Hey,
so
doc.
that's an excellent point. Is you got to be able to deal with the mental pain, and Karl's, that's got to be grounded in the fact that not only does he have confidence in the trend and all the work and data he has, but just the simple fact of if I'm just totally wrong and something crazy happens, I can still pay the bill. So, anyways, Karl. It sounds like we got like 10 months to go. I guess, where do you want to pick up this journey? I mean, this is good stuff. I'm kind of lost on the timeline, so I'll toss the ball to you in terms of where you think we should kind of pick up. And yeah, that's what we call a cliffhanger here in the world of entertainment. So if you want to come back and hear the rest of Karl's journey, then we will see you back in episode 138 when we pick up from where we left off, and we're going to hear the rest about his journey and just, how he's still trading, how he wants to, continue to increase multiple streams of income, and just a lot of good stuff for next week in episode 138. So until then, take care, and we will see you back at next Monday.
This has been the Stock Trading Reality Podcast. Thanks for taking the time to hang out. To learn more about Clay and the Clay Trader community, including the trading team, premium training, and more, visit claytrader.com.